The decade began with silence. Guns had stopped firing in Europe, but the echoes of war still haunted the world. Factories lay in ruins. Currencies were broken. Empires had collapsed. And across the Atlantic, one nation stood untouched, powerful, proud, and rich beyond measure. The United States of America. By 1920, America had become the banker to the world. Gold flowed into New York. The dollar became the new language of commerce. And with that power came something more seductive, the illusion of invincibility. Factories roared to life. Assembly lines turned out automobiles, radios, refrigerators, the symbols of a new modern age. Electricity lit up homes that had known only candlelight. Cities grew skyward, monuments to progress and profit. The newspapers called it the Roaring Twenties. And roar it did, with jazz, with ambition, with speculation. But beneath the rhythm of progress, something darker began to pulse. Cheap money, easy credit, unlimited confidence. After the brief post-war recession of 1920 to 1921, the Federal Reserve slashed interest rates to spur recovery. Borrowing became effortless, and that money, rather than building new factories or infrastructure, poured into Wall Street. At first, it looked like prosperity. Companies were genuinely growing. Productivity was rising. But soon, a different logic took over. Prices weren't going up because businesses were stronger. They were going up because everyone believed they would. By 1924, the Dow Jones began an ascent that seemed unstoppable. Between 1924 and 1929, it tripled in value. Stock ownership spread beyond the elite. Bank clerks, farmers, housewives, even shoeshine boys were trading stocks. Everyone had a tip, everyone had a theory, and everyone believed they'd found the secret to wealth. Wall Street became America's new religion, and speculation, its prayer. But behind the miracle, a dangerous tool was quietly rewriting the rules: margin debt. For the first time, small investors could borrow money to buy stocks, sometimes paying as little as 10% down. It sounded like free wealth. A $100 stock required only $10 of your own money. The rest came from a broker. If it rose just $10, you doubled your investment overnight. It felt like magic. But magic always demands a price. If that same stock dropped $10, the entire investment vanished, and the debt remained. By 1928, Americans owed more than $4 billion in margin loans, equivalent to tens of billions today. The entire market had become a pyramid, built on borrowed optimism. And the optimism was contagious. Corporations joined the frenzy. They borrowed heavily, not to innovate or expand, but to buy back their own shares, driving prices higher and enriching executives. Banks, desperate for profit, invented new investment trusts, early ancestors of modern hedge funds. These trusts used borrowed money to buy other companies' shares, then sold their own stock to the public, creating layers upon layers of speculation. It was leverage stacked upon leverage, a house of mirrors reflecting endless prosperity. Meanwhile, everyday life mirrored Wall Street's success. The 1920s saw the birth of consumer credit, installment plans, car loans, and department store financing. Families could buy everything they desired, whether or not they could afford it. America was living on borrowed time and borrowed money. The illusion was perfect. Income stagnated, but spending soared. Factories produced more goods than people could pay for, yet demand appeared endless, fueled by credit. Economists proclaimed that the old cycles of boom and bust were over. A new age of stability had dawned. They were wrong. By 1928, the signs were already there, faint cracks beneath the glitter. Steel production slowed. Farm prices fell. Unemployment ticked upward. But few cared. Stocks were still climbing. The market had become detached from reality, orbiting a world of its own. Investment houses assured the public that the rise was permanent. Magazines declared that America had entered a new economic era. President Herbert Hoover promised continued prosperity for all. People believed them, because belief is easier than fear. And yet, fear was waiting, quietly, patiently. As summer turned to autumn in 1929, a sense of unease crept through Wall Street. Trading volumes grew erratic. Some insiders began to sell, quietly, without headlines. But most ignored the warning. October came, the month markets remember, and with it, the first tremors of collapse. On October 24, 1929, A Thursday morning began like any other. By noon, it had become chaos. Stocks plunged. Phones rang without answer. Margin calls swept through brokerage houses like wildfire. Investors, desperate to cover their debts, sold everything they owned, which only drove prices lower. Crowds gathered outside the New York Stock Exchange, watching in silence as fortunes evaporated in real time. 5 days later came Black Tuesday. 16 million shares traded in a single day. Blue-chip companies lost half their value. Ticker tapes ran hours behind. No one knew how much they'd lost, only that it was everything. By sunset, the illusion of endless prosperity was gone. When the market fell, it didn't fall alone. It dragged everything and everyone with it. The crash of October 1929 was more than a financial event. It was a psychological one. It shattered faith in markets, in banks, in the idea that progress was inevitable. In a matter of days, the wealth of an entire generation vanished. Investors who had felt rich on Friday were ruined by Monday. Margin calls wiped out accounts, homes, and businesses. But the real disaster wasn't the stock market itself. It was the debt web woven beneath it. When stocks collapsed, investors couldn't repay their loans. When they defaulted, banks lost money. To survive, those banks called in other loans, from farmers, factories, and small businesses. Credit froze. The lifeblood of the economy stopped flowing. Factories cut production. Workers lost their jobs. Unemployment soared, from 3% to nearly 25% within 3 years. A quarter of all Americans out of work. Millions more with hours or wages slashed. By 1932, 13 million Americans were unemployed. Thousands of banks had failed, nearly 5,000 by official count, taking people's savings with them. There was no deposit insurance, no safety net. When a bank collapsed, your money disappeared forever, and the despair spread like a virus. People lined up outside banks, desperate to withdraw cash before it was gone. When they couldn't, they lined up outside soup kitchens instead. Once proud businessmen stood in bread lines next to the workers they had once employed. Homes were lost. Farms were foreclosed. Families drifted across the country, searching for work that no longer existed. It wasn't just an economic collapse. It was a collapse of trust in institutions, in leadership, in the future itself. Politicians had promised permanent prosperity. Economists had sworn the business cycle was dead. Now, the public saw the truth. It had all been an illusion built on credit and belief. And as belief died, the system unraveled. The Federal Reserve, paralyzed by fear of inflation, refused to inject liquidity into the collapsing banking system. Instead of acting as a backstop, it tightened money. The supply of currency shrank by nearly a third between 1929 and 1933. It was a death spiral. Prices fell. Wages fell. Businesses failed. And every failure created more failures. A domino chain stretching across the nation. Farmers couldn't sell crops for enough to pay their debts. They lost their land. Banks repossessed it, and then failed themselves. City governments ran out of money. Public services collapsed. Entire towns were abandoned. On Wall Street, the ticker tapes went silent. The great investment trusts, once hailed as the marvels of modern finance, imploded one by one. They had been leveraged 20 to 1, sometimes more. A mere 5% drop in value wiped them out completely. By 1933, the Dow Jones had fallen almost 90% from its peak. It would take 25 years to recover to those levels again. The so-called masters of the universe were reduced to scavengers. Stockbrokers who had once strutted down Broad Street now begged for work. Some took their own lives, unable to face the ruin. Most didn't jump from windows, as legend claims, but the despair was real enough to haunt a generation. And yet, through the wreckage, something crucial emerged, a lesson, not one written in textbooks, but etched in human suffering. The lesson was this: debt magnifies everything. It multiplies the highs and destroys the lows. It transforms optimism into mania and fear into catastrophe. Every boom carries the seeds of its own collapse, not because of greed alone, but because of leverage. Debt connects everything. When one borrower fails, another lender falls. When one bank fails, others lose confidence. When confidence breaks, the system implodes. That is how capitalism destroys itself, not by accident, but by excess. The Great Depression wasn't simply the result of a bad market or poor policy. It was the natural conclusion of a cycle that had been allowed to run unchecked. Easy money, blind speculation, political denial, followed by the inevitable reckoning. Franklin Roosevelt would later try to rebuild that broken trust. Banking reforms, deposit insurance, public works programs. The system was patched, not healed. But the deeper damage remained invisible, lodged in memory. For decades after 1929, Americans feared debt. They saved. They built cautiously. They remembered what happens when faith becomes currency. But time erases fear. Generations pass, and new investors are born who think the rules have changed. By the 1990s, leverage returned. By 2008, it was weaponized. And by 2025, it has become the foundation of the global economy once again. History, it seems, doesn't repeat. It waits. And then, when the world is most certain it has outgrown its past, it returns. The 1929 collapse was a mirror. And that mirror is reflecting again. It's been nearly a century since 1929. 100 years of innovation, of progress, of lessons learned, or so we tell ourselves. But look closer. Beneath the glittering screens of modern finance, beneath the algorithms and artificial intelligence, lies the same old engine: greed, leverage, and belief. The names have changed. The technology is new. But the psychology? Unchanged. Today, in 2025, the market once again feels invincible. Record stock prices, trillions in corporate buybacks, debt at levels never seen before in human history. And yet, ask anyone. They'll tell you the same comforting story. This time is different. They said it in 1929. They said it in 2000. They said it in 2008. And they're saying it again. The logic is seductive. Artificial intelligence will drive endless productivity. The Federal Reserve will never allow a true collapse. Government intervention can cushion every fall. But that is the very language of bubbles, the denial that precedes destruction. Because if history has taught anything, it's that the system breaks when belief replaces reality. Look at the numbers. Total U.S. debt, government, corporate, and household combined, now exceeds $100 trillion. That's more than 4 times the size of the American economy. Corporations have borrowed not to build, but to buy back shares and inflate prices. Households carry record credit card balances, financing not just homes or cars, but daily life itself. And the government, trapped by its own promises, borrows trillions more each year just to maintain the illusion of stability. The financial world today is built on leverage upon leverage. Hedge funds use derivatives to amplify gains. Retail traders gamble with options and margin. And the rise of automated algorithms has turned the market into a machine, one that trades faster than human panic can react. It's a system perfectly engineered for a modern crash. And the similarities to 1929 are chilling. Back then, it was investment trusts. Today, it's hedge funds and private equity. Back then, it was buying on margin. Today, it's leverage hidden in ETFs and derivatives. Back then, it was radio stocks. Today, it's AI and crypto. Different tools, same delusion. Because what truly drives a bubble isn't technology, it's human psychology. When prices rise, confidence grows. When confidence grows, risk is ignored. And when risk is ignored, collapse becomes inevitable. The market doesn't fall because people stop believing in profits. It falls because they all try to believe and buy at the same time. Then, one day they stop. The trigger can be anything. A failed tech IPO, a sudden rise in interest rates, a geopolitical shock, a whisper of fear amplified through algorithms that sell faster than human thought. And when the selling begins, leverage turns decline into disaster. Just as in 1929, small losses trigger margin calls. Funds are forced to liquidate. Prices fall further. Liquidity vanishes. Confidence evaporates. A century ago, the collapse unfolded over days. In 2025, it could unfold in hours. Because today's markets are digital, instantaneous, global. When the algorithms panic, there will be no ticker tape delay, no hours of suspense. Just a screen going red, everywhere, all at once. And when that happens, all the comforting myths will vanish too. The myth that central banks can prevent pain. The myth that technology can outsmart human emotion. The myth that prosperity can be borrowed forever. They will vanish, just as they did before. But history offers more than warning. It offers a choice. In 1929, those who survived weren't the ones with the most faith in the system. They were the ones who questioned it, who held cash while others borrowed, who resisted euphoria when the crowd demanded celebration. They saw leverage not as opportunity, but as danger. They understood that in every bubble, wealth doesn't disappear, it transfers. From the leveraged to the liquid, from the dreamers to the disciplined. When markets collapse, money doesn't vanish into thin air. It simply changes hands. The question is, whose hands will catch it this time? Because the next crisis won't look like 1929. It will be faster, deeper, and far more complex. Debt has entwined every level of modern life: personal, corporate, governmental. When one sector fails, it drags the others with it. The fragility is hidden until it isn't. The Federal Reserve has spent 15 years insulating markets from consequence, cutting rates, printing money, rescuing institutions too big to fail. But in doing so, it has created something far more dangerous. A generation that believes risk no longer exists. They've never seen their portfolios cut in half. They've never known a real bear market. They've never felt the kind of loss that teaches humility. And when that lesson returns, it will be ruthless. Because markets are not machines to be controlled. They are forces of nature. And when pressure builds long enough, release is not gradual. It's explosive. When faith breaks, when liquidity vanishes, when the system chokes on its own debt, it will not be a correction. It will be a reckoning. And yet, within every reckoning, there is renewal. The ashes of one illusion become the soil for another beginning. The few who remain patient, disciplined, unleveraged, they will inherit the next cycle. The question, as always, is simple. Will you be among them? Because history doesn't repeat, it reminds. And right now, it's speaking louder than ever. The echoes of 1929 are no longer faint. They're roaring through 2025. And if you listen closely, you can hear them. In every headline, every promise, every rally that insists the danger is gone. History doesn't need to repeat, but it always rhymes. And this time, the rhyme is almost complete.